Risk management is one of the most talked about topics in trading. Every trader knows they should manage risk. You hear things like never risk too much, protect your capital, use stop losses. And yet, most traders still fail because of risk. Not because they don't understand the idea, but because risk management breaks down in practice. So, in this video, we will look at why risk management fails for most traders and how you can actually fix it. I am Fotis Papatheophanous and welcome to TTT Markets. Here is the first problem. Risk is emotional. On paper, risk management looks simple. For example, risk 0.5% per trade, use a predefined stop, target a 2-to-1 reward risk. Very clear. But trading is not done on paper. It's done under pressure, after a loss, during volatility, near drawdown limits. And in those moments, risk stops being logical. It becomes emotional. This is where most traders lose control. Let's look at a normal trading situation. Imagine a trader entering a pullback in a trend, something like this. So you wait for the pullback, you have identified the trend, it is higher, the price is above the moving average, the moving averages are pointing upwards, and you have a 2-to-1 reward risk trade. Let me move it like this, and assume that the stop is getting hit. The structure makes sense, the stop is well defined, but the market pulls back a little bit further and your stop is getting hit. So you have a loss. So let's say you take another setup somewhere like here. And guess what? For a little bit, for just a couple of pips, your stop is getting hit again. Another loss. Let me tell you this. This is completely normal, by the way. Every real strategy has losing streaks. It happens. But this is the moment where risk management starts to break. After 2 losses, something psychological happens. The trader starts thinking, I need to recover. I have 2 losses in a row. I must recover. So the next trade becomes larger. Maybe instead of risking 0.5%, you risk 2%. So you go here and you say, right, this time I'm going to move my stop below the moving average. I'm going to be more careful. I need to recover the previous 2 losses and I will risk 2% instead of the usual 0.5%. Maybe you even open multiple positions. Instead of 1 trade, you do 2 or 3 trades. So the risk profile of the account has definitely changed. The strategy didn't fail, risk discipline failed, and that single decision can erase weeks of progress. Let's be honest, increasing risk after losses feels logical sometimes because the mind wants balance. You want to get back to break even quickly, but trading doesn't reward urgency. It rewards stability and discipline. The market doesn't care. They don't care that you are down. So increasing risk rarely improves results. It usually makes the drawdown even worse. Let's look at another situation, shall we? Let me move this because it will be useful for our example. And let's take a look at this situation right here. We have larger candles, stronger volatility, momentum is accelerated to the downside. So many traders see this and they will increase size. They will think this move looks strong. But with momentum also increases volatility. And volatility increases risk. So what happens? You think, okay, this is the bottom. I'm going to do this. It will react, it will go up. I'm going to make a 2-to-1. But again, higher volatility this time. Professionals often do the opposite. They keep the size stable or even reduce it in fast markets. because risk management must stay stable across different environments. Another reason that we mentioned before why risk management fails is overtrading. Risk per trade might be small. You risk 0.5%. Let's say you stick to this. But you take 10 trades in a day and the total exposure becomes large. Now small losses begin to accumulate. Imagine 0.5%, another 0.5%. So after a series of trades, drawdown appears. And most of those trades were not necessary. Professional traders reduce decision frequency. They wait for high quality setups because fewer trades also means controlled risk. Look at this part of the chart, right here, inside this area. Price is moving sideways, breakouts fail, momentum disappears. Usually under these kind of regimes, traders lose control because they keep trading as if the market is trending and they take breakout after breakout and each one fails. Drawdown slowly builds. Good risk management also means recognizing when conditions are poor. Sometimes the best risk decision is not trading at all. So the real meaning of risk management is this: use a stop loss. And this is what some traders think. But real risk management is broader. It includes position size, trade frequency, market conditions, emotional control. Risk is not just about the stop level. It's about how the entire trading process behaves over time. How professional traders fix this? Well, professional traders simplify risk. They do three things very well. First, fixed position size. Risk per trade always the same. Win or loss, it doesn't change. Secondly, limited trades per session. They avoid overtrading. Third, they accept small losses early. Instead of trying to recover quickly, they allow the system to play out over many trades. So they keep variance under control. Let me go actually to daily so you can see something. Let me do this and zoom out. So what you can see here, we have trends, we have ranges, we have different volatility cycles. No strategy wins every week. This is why risk stability matters more than perfect entries. Because if risk stays controlled, the account survives long enough for the edge to work. But if risk expands emotionally, even a good strategy cannot survive. So the simple fix. How do you fix risk management? The answer is surprisingly simple and makes risk non-negotiable. Decide before the session. Maximum risk per trade, maximum trades per day, maximum loss for the session. Non-negotiable. And once trading begins, those numbers do not change, no matter what happens in the market. Most traders believe trading success comes from better analysis, but many accounts fail because of unstable risk. A simple strategy with stable risk can perform well. A brilliant strategy with emotional risk will eventually collapse, because in trading, survival comes first, and survival is built through disciplined risk management. Remember this, in trading, the goal isn't to avoid losses. The goal is to make sure no single mistake can destroy the account.